to print an unlimited amount of money and basically, and until recently, in a non-transparent way, give it to banks who are too big to fail. They can park their money, gain interest on it, and at the same time, you've got to have businesses starving for cash in my area. There are some public policy questions. Go ahead.
Well, right. My point was a lot of people, and I would subscribe to this view, say that there should be no such entity that can just create $1 trillion out of thin air and hand it to rich people. That you don't need to say, well, who should run this organization? There wasn't always a Fed, so if you're going to start questioning it, just go the full way.
Dr. Baker, do you have any comment on that?
Yeah, I mean, the Fed was set up almost 100 years ago, and I think its structure reflects both the power of the financial sector and also the politics of 1913. I mean, it's sort of striking. We have 12 regional Fed banks, and 2 of them are in Missouri. I don't think anyone would set it up that way today. The idea that you would give the financial industry, the banking industry, a major direct say in monetary policy, which the structure of the Fed does. It's not just that they have advice. They basically appoint 12 of the 19 people who sit on the Fed's open market committee, 5 of the voting members. I think that's really hard to justify. So I think having the entity that controls monetary policy, whether it's the Fed or we give a different name to it, I think having that directly answerable to Congress certainly makes sense. And again, one could think of how best to structure that. I, for one, wouldn't say I necessarily want as much respect as I have for the members of the committee. I don't want the members of Congress directly setting interest rate policy, but the analogy I would make is to the Food and Drug Administration that, we expect that they're answerable to Congress.
But I would tell you, back home, people have skepticism, and businesses have skepticism about letting the Fed pass out, free money to certain interest groups, while businesses on Main Street are starving. I mean, thanks. My time's run out. Thanks. I'll go ahead.
I just got one more question, but then I'll give the ranking member one more, or another round if he'd like. But in yesterday's Wall Street Journal, Mr. Ronald McKinnon from Stanford University, the Stanford Institute of Economic Policy Research. Are you guys familiar with Mr. McKinnon? Yeah. Wrote what I thought was an interesting piece. I actually read it last night. He thinks stagflation is coming, maybe here. And he makes the comment, which I think strongly reinforces what Dr. Murphy and Mr. Reinhardt said. The Federal Reserve is the prime contributor to the current bout with stagflation. So I just like we'll go down the line here too, your thoughts on the piece Mr. McKinnon had in the Journal yesterday, and do you think that's where this stagflation concept, do you think we're headed back there?
My wife Carmen and I wrote a paper in August for the Federal Reserve Kansas City's Jackson Hole Symposium called After the Fall. And what we documented was after a severe financial crisis, economies grow more slowly than before for the entire decade. 1.5 points slower in the decade after a crisis than before the crisis. So the real macroeconomy is going to probably be growing only around the rate of growth of its potential. It's going to take a long time for the unemployment rate to come down. In that environment, we're probably in for a spell of subpar economic performance, to the extent that we also lose the anchor of price stability. Then that would be a double dose of problems. I don't think right now the Fed that will necessarily happen. The Fed can be responsible for price stability. I think it could have been more effective in its program of quantitative easing, but I'm not quite as pessimistic as Professor McKinnon.
Well, in Mr. McKinnon's article, he points to the same thing Dr. Murphy mentioned in his testimony, the tripling of the money base, and I don't see it offhand, but he makes some of the same arguments. Dr. Murphy, your comments on Mr. McKinnon's piece?
I actually haven't read that particular piece yet, but yeah, I mean, I've been for a while very concerned about stagflation, that what the policies, both the Federal Reserve and federal government policies the last few years, that would slow real economic growth and also add inflationary fuel. If I could just, one thing I should have said before about the speculators, if I could just say one thing very briefly is, I just want to remind people that it can go both ways. That, for example, when President Bush back in I think it was July of 2008 announced that he was going to end the executive branch's moratorium on offshore drilling, apparently oil prices dropped $9 during the speech itself. Okay, so that's what I mean. That when people think that there are future events that are going to affect the supply of oil, like that can drive prices. And that's
if the Congress of the United States would pass legislation saying we're going to expand dramatically drilling and exploration and get the resources that are out there, most likely that would have an impact on the price of oil, not in the 8 to 10 years that people say it takes to get the product to market, but when it's actually done, when the bill's passed.
Right, because in the way that happens, it's not that there's a time machine. It's that so if people if U.S. Policymakers expedite and give the green light, so people think that U.S. production is going to be higher in the future,
sends a message.
You're right. Then current producers with excess capacity, like Saudi Arabia, they increase current output. So that
just like if we would actually cut spending and cap spending and send a message to the market, that might actually help maybe PIMCO get back in the Treasury market and Standard & Poor's change their outlook, right?
Right. So yeah,
it sends a message. I mean, it's of critical importance. Thank you, Dr. Murphy. Mr. Baker, we got to get back to my first question, Mr. McKinnon's.
Yeah, I have to say I haven't read the piece, but I have to say I'm not very concerned about the prospect of the inflation side of the stagflation. I mean, if you look at the inflation data, it almost all shows very low inflation. And in terms of market expectations, we actually know that because we have futures, we have Treasury indexed, inflation indexed Treasury bonds, and those suggest that the markets are anticipating 1.5 to 2% inflation well into the future. So I'm not concerned on the inflation part. I am very concerned about bad policy giving us slow growth. And in the short term, I don't see any alternative to the deficits boosting the economy because the private sector is not about. Certainly don't see any evidence.
Mr. Baker, let me ask you a question. If big government spending were going to get us out of this mess, don't you think we'd have been out of it a while in light of the fact that for the last 3 years, that's all the Congress, all the administration has done, more spending, almost 25% of GDP, record levels, haven't been there since World War II, quantitative easing policy, the tripling of the Fed's balance sheet. Don't you think it would have done a little better job than it has?
Well, I think
that was the answer.
I think it has done a job. I think that if you look at the size of
the job it's done is we still got 8% unemployment in Ohio.
I think it would probably be 10 or 11 absent those actions. Well, it would still be absent those actions. We lost on the order of $1.2 trillion in annual demand with the collapse of the housing bubble between construction and the lost consumption due to the disappearance of equity, home equity. So that's what we're trying to counter with that. The other part of the story, of course, when you look at trying to rebalance the economy, the only way I see to do that in the long term is with net exports, which involves a falling dollar. I don't know any other way to do that.
Ran over my time 3 times in a row. Mr. Ranking Member, this will be the last round, but you can take as long as you need.
Well, yeah, I want to.
Can I interject?
No, go ahead.
I need to enter the Committee on Oversight and Government report, the majority report, for the record. Thank you, Mr. Chairman.
I want to just begin by letting the Chair know how much I appreciate the fact that you called this hearing, because what I note is interesting is, while the witnesses may have some differences of opinion, the fact that there is concurrence suggests that that there may be the potential for an alliance between conservatives in the House and those who are not conservative or even liberal on some of these economic issues, especially with respect to the role of the Fed. That's not a small matter, and I appreciate that you called this. Dr. Baker, could you take a few minutes to explain the relevance of price inflation here and explain to us the relationship between the price Americans see at the gas pump and the supply of money? Do you have any thoughts on that?
Well, in principle, what you can expect is that in ordinary circumstances, gas prices rise with other prices. That's clearly not the sort of story that we're seeing today. So a conventional story of inflation driven by the money supply is that we throw out a lot of money, which we've done, and then in response, and this has not happened, you would see all prices rising more or less at the same rate. You shouldn't expect to see changes in relative prices. So we see gas, depending what we want to use as our starting point, but let's say we go back to $2.50 a gallon and now we're at $4, we're seeing an increase on the order of 50% in the price of gas. We don't see anything like that almost anywhere else in the economy. We don't see that with rents. We don't see that with medical services. We don't see that with, video equipment. I mean, pick whatever you want to look at. We don't see that. So that suggests that something qualitatively different, something that has really very little to do with the supply of money, is affecting the price.
Well, play that out. I mean, so what does that suggest to you then? I mean, I know you've said this before, but
Well, so what I'm saying is that on the one hand, you have sort of the fundamentals of the market playing a very important role, that you've had rapid growth in the developing world that's increasing demand for oil. That's going to continue. The second issue is the instability, which has to some extent affected the supply. It hasn't hugely affected, but to some extent affected the supply, the instability in the Middle East, that could turn out to be a major factor in terms of actually affecting the supply if it were the case, for example, that Libya's oil were to be come off world markets, that we'd lose the supply from there, or one of the other major producers in the Middle East. And then the third factor is simply that we clearly have some speculation in the market. People are betting that prices will be higher, and they're trying to take advantage of that and pick up the gains, and that at least temporarily pulls oil off the market, pushes up the price.
I want to thank the Chair for, and thank the witnesses for testifying, those who represent trucking and businesses. You know, we appreciate your presence here. I think the Chair has created a forum here for important hearing, and I look forward to working with you as we continue to try to find ways of letting our constituents know exactly what's going on and, you know, what we can do about it to try to take a new direction. Because certainly, and, you know, finally, one of the things that I've advocated immediately with respect to the extraordinary profits that these oil companies are getting in this climate. For example, you know, Exxon, I think they had a $10.7 billion profit in a single quarter. Extraordinary, like a 69% increase over the previous year, which is already pretty high, is think about a windfall profits tax. You know, people have to make money, I got that, but when you're gouging people, you shouldn't get away with it. So we should look for ways, and that wouldn't be on the that wouldn't be at the pump. It would be on the profits. That's the difference. To try to find a way to discipline the oil companies so they aren't stealing from our constituents. So I appreciate the Chair's opportunity to be here, and I look forward to continuing to work with you. Thank you.
I appreciate the ranking member's comments and input and help with the committee. Just quick response to the windfall profits suggestion. Probably not going to go there, as you would expect. But I've yet to figure out how raising taxes is going to lower gas prices. I just don't see how that's going to help Mr. Wanamaker and his business. I don't see how it's going to help the small business owners Ms. Kerrigan represents. I just don't see how that's going to help our economy. But I do want to thank our witnesses, particularly Mr. Wanamaker, Ms. Kerrigan, coming and giving us a small business perspective, and our others on the Fed role and on the broader economic concerns. Thank you for being with us. I apologize again for having you have to stick around this late in the afternoon. But thank you for being here today and giving us this valuable testimony. And we're adjourned.